These people on the Federal Reserve spend supposedly all of their time figuring out these econometric equations based on complicated calculus of pages and pages of crap filled with these equations with Greek letters all over them to come up with these huge policy decisions. And she's still saying she doesn't know and she hasn't formed an opinion. What the hell are you spending all your time doing all this math for? Hey guys, it's Rafi of the Endgame Investor, and today we're going to go through a really wacky interview that the Wall Street Journal conducted with Esther George, president of the Kansas City Fed. What does Esther George say? She says that in order to stop the yield curve from falling, the Fed is going to have to sell bonds outright, which the Fed has done before to amazing, spectacular success. Central bank should weigh asset sales to curb inflation, says Fed official. Kansas City Federal Reserve President Esther George says removing stimulus should be systematic. A top Federal Reserve official said that the central bank should consider selling bonds from its $9 trillion asset portfolio to address high inflation and guard against harmful effects that can result from raising short-term rates above long-term rates. What is she talking about, raising short-term rates above long-term rates? She's talking about this. This, ladies and gentlemen, is the yield curve spread. It is the difference between 10-year yields and 2-year yields on Treasuries. You can notice something very interesting about this chart, and it is, you see this line where it says 0.00, at that point is when short-term rates are higher than long-term rates, and the difference between 10-year and 2-year is negative. Now, if you time this up with what has happened in recent history since the turn of the millennium or century or whatever you want to call those zeros, is this. Here is 2000, 2001, when the yield curve first went negative in this century. What happened in 2000, 2001? That was the popping of the NASDAQ.com bubble. And you have here the peak of the housing bubble, the top of the S&P 500 in October 2007, and finally the financial crisis of 2008, which began to foment around here when the yield curve was last negative. And here you have the last time that the yield curve dipped below zero when short-term rates were higher than long-term rates. What is this point? This is September 2019, the repocalypse, so-called, when short-term rates skyrocketed to 10% overnight as the overnight loan markets from bank to bank broke down entirely, and the Fed had to print about $1 trillion in repos in 2 days. So we do know that whenever this yield curve spread goes negative and short-term rates trade above long-term rates, bad things happen to the financial system. Things that are weird, things that are Twilight Zone-y, things that should not be happening in a regular universe. Anyway, let's go back to the interview. Here are her words. There was an explicit recognition that introducing quantitative easing, money printing, was going to complicate monetary policy, she said. So I don't think we can avoid the complexity that has come with the decision to deploy this tool. At the same time, she said, what you don't want to do is oversteer here. What you don't want to do is oversteer. The Federal Reserve has printed $6 trillion since March 2020, and what you don't want to do now is oversteer. What do you think you've been doing since the 2008 financial crisis?
That's what he does! That's all he does! You can't stop him! He'll wait for you, reach down your throat, and pull her heart out!
You've been oversteering. You buy $9 trillion in bonds, and you think that's not oversteering, and now you don't want to oversteer? Oversteering is basically all you do.
But existing is basically all I do.
In recent speeches, Ms. George continues, Ms. George has signaled concern that maintaining a large asset portfolio could hold down long-term rates in a way that distorts lending conditions, particularly as the Fed steadily raises short-term rates. You think that buying $9 trillion in bonds is going to hold down long-term interest rates and short-term interest rates? You think that's possible? It's like having an oil trader saying, I think that buying 1 trillion barrels of oil is going to raise oil prices. Or a real estate investor. I think that buying $1 trillion in housing is going to manipulate housing prices. You think that buying $9 trillion in bonds is going to manipulate debt prices? You're a genius. Maybe that's why you have all this math to your economics. My guess is, she says, her guess, she's guessing, with a $9 trillion balance sheet pushing down on long-term rates, we're going to have to face some considerations about how much downward pressure is being placed on various maturities of Treasury securities, she said. How much downward pressure is being placed on Treasury yields? How much? I'll tell you how much. If you have a $9 trillion balance sheet, it's $9 trillion of downward pressure. That's how much pressure, okay? It doesn't require a lot of math to determine that $9 trillion is $9 trillion. It's an identity. It's symbolic logic. You learn it in philosophy. A equals A.
Identical.
Next sentence. Actively selling mortgage securities could provide one way to reduce such stimulus, but it is something the Fed never did during an earlier effort between 2017 and 19 to shrink its holdings. Let us go to a chart that you may have never seen before. What happens when the Fed sells treasuries? This is the amount of US treasuries on the Fed's balance sheet since 1970. It goes up steadily and smoothly until, what's this? Q4 2007. And what was happening here? The price inflation rate was rising to about 4.5%. And Ben Bernanke, who was in charge of the Fed at that point, decided it is time to shrink the balance sheet because price inflation, consumer price inflation, is a bit too high for his tastes. So what does he do? He reduces the Treasury portfolio in his balance sheet for his precious bank, the Federal Reserve. It goes down from $740.6 billion in Q4 2007 all the way down to $476 billion in Q4 2008. And guess when the financial crisis exploded? That's right, folks. Right after the Fed, for the first time, majorly reduced its balance sheet of U.S. federal debt. Here's QE1, here's QE2, here's QE3, here's the break, and here is when the Fed allowed Treasuries to roll off its balance sheet without renewing them, and the balance sheet shrank. And here is September 2019, the repocalypse, when interest rates suddenly skyrocketed to 10% overnight, and the Fed had to print $1 trillion in repos in 2 days. This is the bottom of the balance sheet, Q3 2019. What happens by Q4? It rises from 2.4 trillion to 2.6 trillion. This is still pre-COVID, people. Q4 2019 to Q1 2020, from 2.6 trillion to 3.5 trillion. This is still pre-COVID, but you see here the rate from Q4 2019 to Q1 2020, and then the rate from Q1 2020 to Q2 2020 is about the same, nearly vertical, meaning the money printing started before COVID began, at least the Treasury buying. And so we see by that chart that the 2 times that we see an appreciable decrease in the amount of treasuries on the Fed's balance sheet, both times you had severe financial crises. What does she think is going to happen this time? Nothing? Is she going to oversteer into, I don't know, a financial iceberg?
Iceberg, right ahead! Engage the reversing engine! It's got ahead!
Given the current state of the economy with high inflation and low unemployment, the Fed doesn't have the luxury it had several years ago of spending more time to design its strategy. Ms. George said, well, the Fed is out of luxuries. Let's all mourn that the Fed is out of luxuries. And what are we doing? She added, that doesn't mean in March we're going to have to say, let's start the sales. Ms. George said she hadn't yet formed a view over how much the Fed would need to raise interest rates this year. She hasn't formed a view yet. She doesn't know.
Where is the peace conference? She does not know.
These people on the Federal Reserve spend supposedly all of their time figuring out these econometric equations based on complicated calculus of pages and pages of crap filled with these equations with Greek letters all over them to come up with these huge policy decisions. And she's still saying she doesn't know and she hasn't formed an opinion. What the hell are you spending all your time doing all this math for? Imagine if a physicist who was commissioned to build a space shuttle and he's asked by NASA, what do you think the trajectory of the re-entry angle of the spaceship into the Earth will be so as not to burn up the ship and make it explode? And he says, well, gee, I haven't formed an opinion yet. So what the hell are you doing with all of your physics equations? You're trying to calculate that damn angle. So she's basically saying all of the stuff that I do to calculate whatever is worthless, which we all know, but it's just academic cover for her to earn hundreds of thousands of dollars a year on a taxpayer salary, doing absolutely nothing but printing money. With inflation up 7.5% in January, and the Fed's benchmark rate near zero, our policy is out of sync. Out of sync. That is a wonderful way of putting it. Now, before I finish with this final quote, you remember when the entire Fed was talking about transitory? Did you hear anything from Esther George? I didn't. Here is her final quote. I don't know that I'd call the markets reacting to data an emergency here, because frankly, in my own forecast of looking where inflation was moving, the print was not a surprise. So Esther George apparently knew the whole time that inflation wasn't transitory. She wasn't surprised. She knows it's going higher, and yet she has no opinion on how fast rates should be hiked, despite all the math that she does in her room all day. These people are clowns. They are in charge of the entire money supply. They have no idea what they are doing, and all they do is they print money.
It doesn't feel pity or remorse or fear, and it absolutely will not stop
Until the dollar is dead. This is Rafi of the Endgame Investor. If you want more than rants and raves at a video, please sign up for a 2-week free trial of the Endgame Investor, and you'll get more of a real approach to monetary economics from a true Austrian school perspective that doesn't have anything to do with calculus that nobody cares about in the end, but rather logic and human action. And if you are into other things, liberty and libertarian, please consider becoming my patron on Patreon for as little as $3 a month, where you'll get extra libertarian content. And right now I'm focusing on my biblical commentary, Liberty on the Tablets. Have a good week, everyone, and God bless Canada.